Deep inside the global credit markets, a specific mathematical pattern has reappeared for the first time in 17 years. The last time this exact signal triggered was in the spring of 2007, exactly 6 months before the cascade of failures that triggered the 2008 financial collapse. Right now, 99% of retail investors are missing this warning entirely. They are watching their equity portfolios, tracking daily stock prices, and assuming the economy is stable. But the stock market is essentially the paint job on a car. The bond market is the engine. When you ignore the actual mechanics of global credit, you leave your portfolio completely exposed to a sudden, catastrophic loss of wealth. This diagram charts the basic hierarchy of corporate bonds. At the top, you have safe companies with AAA ratings. At the bottom, you have riskier companies carrying lower ratings. These are widely known as junk bonds. Because those bottom-tier companies have a higher chance of going bankrupt, they have to pay higher interest rates to attract money. The difference in yield between the safest bonds and the riskiest bonds is called the credit spread. It is the mandatory compensation you receive for taking on default risk. But look at what is happening today. The spread between the absolute riskiest junk bonds and the safest junk bonds has completely collapsed. The market is pricing companies on the edge of bankruptcy as if they are entirely safe bets. Imagine walking into a bank. A person with a 400 credit score and a history of missed payments applies for a loan, and the bank offers them the exact same interest rate as a person with an 800 credit score. That bank would go out of business. Right now, the entire global credit market is operating with that exact lack of logic, completely detached from the reality of risk. Why are investors acting this way? Because in a low-yield environment, capital gets desperate. Investors are so starved for returns that they are recklessly buying up the debt of extremely risky companies without demanding the interest rates required to cover their actual risk, and that creates a dangerous second wave. Because investors are throwing cheap money at terrible investments, failing zombie companies, businesses that bleed cash and should have gone bankrupt years ago, are able to refinance their debt and stay alive. These zombie companies keep their doors open. They keep spending money, and the broader stock market looks at all this ongoing corporate activity and assumes the economy is strong. The surface-level stability you see in your stock portfolio today is an illusion. It is propped up by a broken credit market, masking a systemic pressure cooker that is silently building underneath. This towering bar chart visualizes the true scale of the problem. We are looking at $10.5 trillion in corporate debt. That vastly eclipses the debt levels we saw leading up to the 2007 crisis. All it takes is a single spark to blow those compressed credit spreads wide open. Whether it is sticky inflation forcing the Fed's hand, or sudden geopolitical instability in the Middle East or Eastern Europe, a sudden shock will reset the market's appetite for risk. When that happens, the credit markets instantly freeze. The cheap money vanishes. Zombie companies suddenly cannot refinance their massive debts, and mass defaults begin. This dual line chart reveals exactly how this plays out chronologically. Notice how the credit market line plummets first in late 2007, but the equity market line, stock prices, stays elevated for months before finally collapsing. This is the lag effect. In 2008, everyday investors didn't panic until major institutions began publicly failing in the fall. By the time Lehman Brothers collapsed in September, anyone holding standard stocks was already locked into a 57% downward spiral. High stock prices today do not offer safety. They simply represent the calm, mathematical lag period before the credit freeze inevitably flows into the equity markets. But that historical lag effect is also your biggest advantage. It gives you a 6-month window of time. If you understand the signal, you can position yourself to not only survive the cascade, but generate massive wealth from it. Step 1 is building a cash position right now. You need dry powder. Step 2 is rotating out of high-risk, highly leveraged companies. Unprofitable small-cap stocks, especially those in the Russell 2000, will be the first to get wiped out when credit tightens. Step 3 is looking into defensive volatility hedges, like inverse credit ETFs, which actually profit when spreads explode. Step 4 is identifying target companies with bulletproof balance sheets and massive cash flows. You want your money ready when those premium assets go on sale. Finally, Step 5 is mental fortitude. When credit spreads blow out and the market panics, human psychology will scream at you to freeze. You have to be prepared to step in and buy while everyone else is discarding assets. Credit cycles and market crashes are an inevitable mathematical reality. The only difference between losing your portfolio and securing a financial future is whether or not you spend this lag period preparing. As always, this is for educational purposes, not financial advice. Do your own research. If you want to know exactly which sectors are going to take the heaviest hits when this breaks, make sure you subscribe, and I will cover this